Investment flash.
Stocks party on the Iran pause, but AI investors are starting a revolt. Monday, July 27th, London edition. Let's get into it.
Good morning. I'm Marie with Tom and Gerald. Oil just dropped over 4%. That's the easy headline. But underneath, a whole different story is brewing in big tech.
Yeah, look, crude down 4% on the US-Iran pause, the US oil fund up 11% in a week. So this relief sell-off has room. We've been saying sell the oil ETF.
Hold on. The pause is fragile. One drone and we're back above 100. MarketWatch's triple threat was all about surging yields and oil breaking out. That reversed today, but it's not over.
Exactly. And with crude down, bond yields should follow. Buy the long-duration Treasury ETF. It's just 1% above its 52-week low. Any dip in yields and it rips.
To be fair, long bonds at these levels are a coiled spring if the Fed blinks dovish. But energy equities, the energy sector ETF up 30% year to date. The easy money's done. Falling crude plus rotation out of value.
Right, and the rotation is real. But the convergence today is the AI spending revolt. Bloomberg says investors are in open revolt over big tax capital returns, and CNBC warns wider credit spreads will make the AI buildout pricier. That's a two-punch combo.
Exactly. Right. That's the whole story.
Nailed it.
Whoa, you're saying the AI trade is done? NVIDIA's at 16 times forward earnings, buddy. That's not expensive for that growth. And the $700 billion US-Korea deal? More demand.
Tom, the same NVIDIA you called a buy yesterday. Up 10.5% year to date, fine. But the revolt is about whether the billions in capex generate returns. If credit tightens, expansion plans slow. CNBC's take is key. Debt markets choke the build-out.
Exactly. The relief rally from cheaper oil won't thrive if the growth engine gets a margin call. Our view, these stories are incompatible. The market is split.
But look at the analyst calls. Morgan Stanley 502 on Broadcom, Stifel 230 on CrowdStrike. These are long-term secular growth stories.
Broadcom already up 12.9% year to date, Tom. Near-term upside limited. CrowdStrike up 61.8. When does that pullback come?
And AST Space Mobile down 29% with a $100 target from Piper? That's a turnaround play if you can stomach the volatility. But the luxury outlets? Tapestry at 42 times trailing?
42 times? That's heartburn material. Ralph Lauren at 24.8 is fairer, but Capri at 0.7 forward after a 36% plunge? Cheap for a reason.
Oh, come on. That's brutal. Wait, Capri's a deep value play. Michael Kors outlets are cash machines. You love value, Gerald. 0.7 forward?
I love value that isn't a value trap. Kors outlet sales aren't exactly a growth story, mate.
All right, but the key is the Japan angle. Bain reaping $17 billion from Kyosha, that's a maturing PE market. The yen at multi-decade lows means BOJ rate hike bets are up.
And Hedge Japan, the currency hedged ETF, up 21% year to date. If BOJ hikes, yen strengthens, Hedge Japan outperforms. But everyone's in that trade, so maybe wait for a pullback.
Now, the broader Japan equity story's real. The Japan ETF is at its 52-week high, up 12% year to date. That PE exit signals foreign capital finally trusts Japan. Structural shift.
Exactly.
Yep.
But let's talk UK banks. FT reports lenders accuse the Bank of England of ignoring Wall Street's capital edge, $22.5 billion extra burden.
That's a direct hit to Lloyds and Barclays. Lloyds near its high, Barclays at 1.1 times book. Sell Lloyds, sell Barclays. The market hasn't priced its disadvantage.
But JP Morgan at its high too, Gerald. The US edge is priced. If everyone's crowding into US banks, that trade loses edge.
Hold on. The UK capital disadvantage has been there for years. If the BOE ignores it, that's not new. The real risk is if the UK economy slows. Banks get hit regardless of capital levels.
Fair enough, but the FT piece adds new data. It's a fresh catalyst. I'm watching.
All right, but the US-Korea AI deal, $700 billion from Samsung, SK, and NVIDIA. That's just more demand for chips. NVIDIA's still the linchpin.
Tom, NVIDIA forward PE 16. The deal is sentiment booster, sure, but it's already priced. And remember your buy call yesterday, already up 0.5%? Priced in.
Wait, but Samsung's memory business could be the sleeper. Shares are flat, offering a potential entry if AI infrastructure really takes off. SK Telecom up 71% year-to-date, though, so caution.
I'm telling you, the AI CapEx cycle isn't over. If earnings surprise, the revolt will fade. And the triple threat? The oil plunge today contradicts it. Technical breakdown may be false.
See, this is what I mean. The triple threat says yield surging, oil breaking out, dollar uptrend. Today, oil plunged and bonds rallied. The setup is already breaking. The S&P is just 3% below peak.
Exactly. If the Fed leans dovish, bonds get run over and stocks melt up. I'm watching NVIDIA earnings, not triple threats.
All right, but long bonds near lows means the bond market already priced for slowdown. If there's no recession, yields could spike again. That's the real threat.
Which brings us to our view. It's not directional, it's dispersion. Active management over passive. Cash over credit. Long delta hedges like the volatility ETF, down 53% from its high, for a week that could break either way.
Volatility hedge? I'd rather buy the dip in semis, buddy.
Of course you would, Tom, but the credit angle is underappreciated. If spreads widen, the high-yield bond ETF gets hit. That's my sell.
Okay.
And don't forget the Fed meeting Wednesday. Rate options pricing a 60% chance of a cut. Powell could push back. The second-order trade is dispersion, not direction.
Right, but the buy-the-dip mentality is strong. If big tech earnings surprise, the revolt is over. I'm watching the tech sector ETF, up 23.7% year-to-date, but that could run further.
Tom, remember when you said semis were cooked in Q2? And they ripped? Now you're all in again. Look, mate, check the credit spreads. That's the warning.
Ha! Fair enough, Gerald. I've been wrong before. But this AI bonanza drowns out everything else, just like our weekend call said.
Speaking of which, that call on Alibaba and Amazon from yesterday, interesting day ahead. But today, the convergence is the revolt. And Gerald's right about the credit market angle.
CNBC's original take, the debt market impact on AI buildout, that's the one to watch. Few are making that connection. It's structural.
Totally.
Spot on.
Asked Space Mobile with $100 target. Piper must be smoking something. But hey, turnaround stories sometimes work.
I mean, he's not wrong. Japan's the overlooked story. Bain's exit is huge, and if BOJ hikes, the yen play is on.
Exactly. Hedged Japan is up 21%. But if the yen strengthens further, that's more upside. The BOJ meeting is the catalyst.
Look, today's signals map a split market. Oil relief versus AI revolt. The Fed could tip it either way. As always, none of this is investment advice.
We're back later today at 9 a.m. New York time. If you're just finding us, hit follow on Spotify or check investmentflash.com for charts and sources. See you then.
Catch you in a few hours. Cheers.
That's the London edition, back at 9 a.m. New York.